Welcome to chapter 10. We're going to go over the slide deck or the lecture of chapter 10. During this video, I will be giving a word, at which point you will get that word and you will plug it into the quiz that you click this link from, probably. I guess there's two places I put the link. But anyway, and put the word that I will say during this time. But this one, we'll talk about plant assets, natural resources, and intangibles. Our focus is plant assets. Oh, my keyboard's not. There we go. All right. And then this is the learning objectives. You can look at those and pause them if you want. So what is plant assets? Well, plant assets is property, plant, and equipment. That's how we used to classify it, and we didn't even call it plant assets. We just called it property, plant, and equipment. Bottom line is anything that is associated with property. So although, we may be talking about land, we may be talking about stuff like that, but also the buildings, I'm sorry, things that are on the land as well. Like, you look at a parking lot and you think that's just a parking lot, right? Land. No, but there was a cost to lay the concrete and to put in the lighting and other stuff like that. That stuff is also part of property, plant, and equipment. It's called land improvements. Buildings, equipment, furniture, fixtures, automobiles, things like that. These are all what we're going to look at as property, plant, and equipment. How does a business, I'm going to read the slide properties. Bottom line is what we need to do, what we have is we can't violate the expense recognition principle. When we purchase a plant asset, it is a lot of money. So when we purchase the asset, that asset's going to last longer than 12 months. Let's take, for instance, a building. If you buy a building, that building is going to be used probably for several years, talking 30 years, 40 years, 100 years, we don't know. So, but what we're going to do is we can't just pay the money for that asset and expense it in the same accounting period that we spent it, because we're not basically using up the useful life of that asset in case that we're doing these buildings. Therefore, what we are going to do is we are going to break up the cost of that asset. We're going to spread it out over our estimated useful life of that asset. Now, when I say that, as my dog scratches himself in the back, luckily, at least he wasn't doing something else. Anyway, the asset doesn't necessarily, like, if we're going to depreciate a building, we may use 30 years. Is that building going to last 30 years? I mean, is it going to last 50 years? Yes, probably. Okay, it's probably going to last a long time. We're just going, the whole point of this is just to give an estimated time of how we expect to use it, expense the cost of it over that life. And it's just a means of showing that we are attempting to follow the matching principle. So if we bought a building and then we let's say we use 30-year useful life. Okay, that's reasonable. All right, we're spreading the cost over that 30 years. If we bought a building and tried to spread it out over 5 years, not so reasonable, because that building, unless you're, I just recently heard about these places called rage rooms, where I guess you go in there and just break things. I'm thinking, what a waste of resources, but whatever, I guess it's a thing. Maybe a building like that won't last very long. I don't know. So that said, you have to come up with a good, useful life of that. And that's what we're going to do. That's the whole point of that, is so that we don't violate the expense recognition or matching principle. All right. So here are the three important aspects of the plant asset. It's the acquisition, the use, and the disposal. And that's what we're going to go over too. we kind of already went through this, but what do we include in the cost of that asset? When we buy something, it's more than just the cost of it. So what are we going to look at? What are we going to think about? Let's go ahead and look here at our land and land improvements. So purchase price, let's say you had a brokerage. Hold on, my dog needs to jump down. There you go. Go on, go investigate. Oh, my dog with that dog sometimes is pretty nuts. Anyway, so we're gonna put in everything else. Maybe when we're buying this land, we need to have it surveyed. We need to have the title transfer fees. I mean, if you've ever bought any land, like I bought my house, man, it's a lot of work. You get these people to inspect, you get these people to come and inspect. All that cost is put into the price of the home, and that's what we're going to include in that. So one of the things, though, just for the record, as we get closer, and we'll talk about it later, probably is that land is not depreciated. So remember that. Land improvements are. Here's some more stuff, but these things don't get put into the cost of the actual land. They get put into land improvements, sprinkler systems, lighting, signs, things like anything that is not associated directly with the land, but is an improvement of the land. All right, let's look at this land improvements. Okay. Situation here. So we have an exhibit. We buy all this stuff, all these costs. The total cost of the land is basically everything added together, right? Everything added together. Here's our journal entry. We're going to debit land, credit notes payable. If we used basically in this situation, the land that we bought, we were told it was $62,000 for all of the costs. So we're going to debit land at 62,000. That's the asset that we're going to carry on our books. And looks like here we paid $12,000 down payment, $50,000 borrowed from the bank. That's what this journal entry is reflecting. There is an emphasis here on the definition of what capitalized means. So it's basically any expense that we incur that gets put to the cost of a property, plant, and equipment or a long-term asset. Capitalizing means we're just going to be expensing that cost over the useful life of an asset. It's all capitalization means. It's like this, ooh, we are capitalizing that. Like some people might even think, oh, that sounds so cool. It really is just saying, hey, this money we spent, yeah, we don't get to take an expense on it until we are until we depreciate it fully. Okay. But land itself is not depreciated, but land improvements are. And since they're very different, whatever land improvements, when we installed the fencing, paving, and stuff like that, we are going to put that into land improvements, and we will depreciate that over the land improvements useful life. I used to do financial statement analysis. Like I would get their financial information, I would review it, I would assess whether or not I agreed with what they were presenting, things like that. I was not an auditor in this situation. I was an auditor before that, but I did different auditing, not financial statement audits. Anyway, we had engineers that we would have them go out and they would assess these assets and determine what their useful life is. Because I mean, you could be an actuary and you could kind of come up with stuff like this, or do say if you're an actuary, man, you're probably gonna be high demand and lots of money. So what you make, but you're be very busy. But I digress. The engineers would say, hey, this land is X, this land improvements are Y, these other property, plant, equipment is this. We think that they came up with a reasonable estimated useful life, and some of the assets were depreciated over 30 years, some 40 years, some 2 years. So it just depended on what the asset was, its use, and how often they had to either completely replace it or it's how long it took to basically break down. So I'm not going to go through all these slides because now we're talking about buildings. You can pause this and just read kind of what costs are included in there. Here's our machinery and equipment. These slides are focused a lot on what you put into these assets. And that's good. You do need to know that. But I'm just not going to spend a whole lot of time going over them. I'm going to go over with this slide, this in the next three, about what happens when you buy a bunch of assets together. So when you buy a house, you're not just buying a house, you're buying the land underneath it, typically. Although I will say, when I lived in Flagstaff, the city council were, I don't know if they ever did it because I ended up moving out pretty quick after they started talking like this. Not because of that, but I wouldn't have been happy doing it anyway. They wanted to keep the land and just have the homes built on it. You'd own the home on the land, but the land was the city's and you paid them a rent. And listen, if that ever happens, if that ever happened up there, don't ever do that. It's like, I don't know if you're familiar with the trailer parks. That's what they are. You own your trailer, you don't own the land that those trailers are on. And I never lived in one myself. I did know a couple people that I did uh, interact with quite a bit who were in those situations, and it was not, own your land, own your land. That's all I'm gonna say. Anyway, so but you're buying them both, okay? But if you have to, sometimes you have to identify, hey, especially for our books as accountants, if our company or someone buys a chunk of land and a building and stuff, we have to allocate whatever cost we spend to both of those. So what we're going to do is we're going to come up with the fair value. We're going to go ask someone to come do an investigation, which of course we're going to put into the costs of these assets as well. But we're going to say, hey, go look and get appraisals. What I was thinking, go look at this land in this building. Tell me how much you think both of them are, independent of each other. Appraiser goes out there, they do their little thing, and so many stories about appraisers, but I'm not going to get into them. They'll come back and say, hey, we think that the fair market value, in this case, says the land's market value is 30,000 and the building's market value is 90,000. Okay, cool. So the market value is 120,000. Well, how much did we pay? 100,000. So what we're going to do is we're going to take the total market value, and then we're going to take of that total fair market value, divide what the fair market value of the land was by that total, and the building market value by that total to come up with a percent. And in this case, 25% of the fair market value was land, 75% of the fair market value was the building. Then we're going to multiply our cost, which was 100,000, by that percentage to come up with how much of that 100,000 is allocated to land versus the building. So once you do that, then you just journalize it: debit land, debit building, credit notes payable in this case, or cash, depending on whatever the circumstances are. So, oh, there we go. All right. So, what is the difference between a capital and a revenue expenditure? Revenue expenditures just simply means we're going to expense it in this accounting period. Capital expenditure means we're going to put it into the cost of the useful life of the asset and depreciate that along with with that asset. So, whatever increases the useful life or improves the capacity and efficiency of a asset, we are going to capitalize that. Anything that just keeps it running is going to be expensed. So let's talk about what's the difference. Let's take cars. You drive your car, you get the oil changed, you put gas in it, you get it cleaned, and you go to the car wash. All those are going to be what this book calls revenue expenditures. I'm just calling them regular expenditures. That's what that is. It's just expenses. We're going to expense those. Let's say I need to go and get my engine redone, or I need to go and get my tires replaced, right? That's going to extend the life. It's going to, I mean, I guess tires could be, that could be one of those gray areas now that I think about it. But I would still say you're going to capitalize that in theory. I mean, there's also thresholds that you meet and stuff if you want to get into the weeds, but we don't want to do that. But let's say you're going to take and you put a brand new engine in there. Yeah, that's definitely going to extend the useful life of the asset. You're going to do any major repairs like that. Anything like paint, or I mean, even if the paint costs a lot, you're going to expense it because that doesn't improve its usefulness. It's not extending the life. It's not going to make it to where you're going to have a somehow an increased mileage on that. So it's just not happening. All right. Another thing. Let's think of a building. Okay. Let's say it's your house or something like that. You have some maintenance costs, right? You're going to replace your filters in your air conditioning and heater. I'm thinking of all the stuff I do. Um, you're going to patch holes in the wall. I actually did a can I think about it? Doorbell install, and I needed to wire it to the internet. I was like, what? So I had to run a wire a H not HDMI internet cable, a network cable. My roof, man, dude. Let me tell you, that was fun. Doesn't matter. It's still a regular expense. But if I am to put in a new room, take out a wall, um, things like that are going to actually improve it, make it more efficient, whatever. Yeah, then those are going to go in there. Can't say I've ever done any. Um, Sorry, I went the wrong way on that slide. Sorry, I did accidentally hit my mouse button that rolled. So anyway, all right. Sorry. Oh man, oh my gosh, I went back really far. Oh, no, no, no. We changed to a truck. Okay. All right. Same thing with the truck. Same thing. We've kind of beat this horse, I think. Repairs and maintenance expense is what you're going to do for vehicles when you're just repairing them or doing something. Oh, this one says replacing tires. So we are going to repairs and maintenance on the tires. I don't know. I guess I just see it a little differently because the tires, I mean, if you don't replace your tires, your car is no longer useful. That's kind of how I was looking at it. I could see an argument both ways, but I guess let's go with what the book says and we'll call it an expense. Anyway, you could pause this, look at this if you want. This is kind of the idea of what kinds of expenses are going to go to a capital, if you're going to capitalize it or if you're going to expense it in the accounting period. This talks a little bit about data analytics. I'm just going to kind of pop over that. Okay, let's talk about straight line. This is really where the meat and the potatoes are of this chapter. And how do we calculate what we need to expense? Well, we're going to need some things that we're going to need to use. First things, we're going to need to know the amount we're capitalizing, how much we're going to depreciate. We need the useful life. We need the residual value. If I use salvage value, I mean residual value. Uh, Different books call it different things. Residual basically means leftover. Salvage, whatever you have left over. They all mean the same thing. It's just different books call them different things. Um, and so there's a depreciable cost, and then we're going to call that what that is going to be whatever the capitalized cost is minus whatever the residual salvage value is, residual value or salvage value. And that's because the residual value and the salvage value is what we expect to get back from that asset if we sell it by the end of its useful life. So think of a car. If you have a car, you pay $20,000 for it, and you're like, I'm going to drive this thing for 4 years, and in the end of the fourth year, I'm going to sell it, and I think I can get $5,000 for it. $5,000 is the residual value. So we're going to take the cost 20,000 minus 5,000, which is the residual value, and that amount is 15,000. That's the depreciable cost. That is what our focus is going to be on for most of these methods we're going to teach you here. All right, depreciation methods include straight line, units of production, and the double declining balance method. Please do keep in mind, there are a lot of methods out there. If it makes sense, if you can calculate it, knock yourself out. If it looks like that follows your business model better, great. The thing is, all of these are approved for generally accepted accounting principles, so you can use the easiest method or the hardest method, doesn't matter, whatever you want. The kicker is you just can't keep changing. Once you select it, you just got to go with it. And if you change any of these, just like in accounting 111, if you tried to change your inventory valuation method from LIFO to FIFO, you got to restate your financial statements for the past 3 years. So you pick one and you kind of just run with it. Don't be changing stuff. How we do the straight line method is the easiest one and is done by 95% of all companies. And I get that number from another book I read. Could be changed, could be 94, could be 96. Point is, the majority of companies, a healthy majority, use this method. Why? It's the easiest. There's no point in complicating this because, as you're going to see, when you get to the end of the useful life of every single asset, doesn't matter which method you use, you get to the same number. So are you going to do that in a difficult way, or are you going to do it in a easy way? Most people try and do it the easy way. Follow the water, right? Water goes path of least resistance. All right, we're going to take the cost minus the residual value, which we know is depreciable cost, and just divide it by the useful years. And once you get that amount, that's what you expense every year until you sell the truck or you fully depreciate it. We're going to debit depreciation expense and credit accumulated depreciation. You should be familiar with this journal entry. You learned it in Accounting 111. Depreciation is recorded in the income statement, is the depreciation expense. Accumulated depreciation is put on the balance sheet. As you can see here, we're going to list property, plant, and equipment. We're going to display truck. This is on the balance sheet. We're going to list the value of the truck, total accumulated depreciation we have of that asset, and then we're going to show what's called the net amount of that truck, or there's another term for it, the book value. It's right there in bold, right there. I should have looked up. Um, sometimes, the brain's just not braining. But anyhow, you see the point. Let's show you. This is the depreciation schedule, and it just shows you. We calculated $40,000 that were depreciation divided by 5. Well, guess what? In 5 years, you have $1,000 left over. And that's what we expected to sell for, and that's what our residual value is. Great. Now we'll go in later on what happens if you have, when you sell it for more or less than what you estimated. Units of production. It means exactly what it says. We are going to estimate the cost based on how many units we produce. This method is interesting. It's a little more complicated, but it's still straightforward. Depreciation, you're going to take cost minus salvage value or residual value, and you're going to divide it by the total number of units you expect to produce. If it's a car, how many miles you're going to drive. If it's a piece of equipment, that it is how many units you expect to produce from that equipment. Depending on whatever the equipment is or whatever it is that you bought, you got to come up with a logical, reasonable base and estimate it. Notice this is an estimate. You're giving it your best shot. Okay, so if you end up being wrong, there's ways to adjust that we'll get into. It doesn't matter though. You don't need to freak out. It's just an estimate. So once you get that, we're going to depreciate this vehicle, this truck, 40 cents per mile. We're going to track the miles, and in year 2, or what is this? I guess year 1. Oh, that's convenient. They put 20,000 miles so the year 8,000, just like the other one, whatever. Anyway, so you do the math, take the miles per unit, or the cost per production, unit of production, multiply by the total number of that production, in this case miles. First year we got 8,000. Let's look at what they did. All right. So we have our depreciable per unit is 40 cents every year, no matter what. The number of units or the miles driven is the next column. 20,000 first year, 30,000 second year, 25 third year. Why does it get down to 10,000? Why does it go down like that? Well, you're using the truck. At some point, you're going to have a lot more maintenance than when it's brand new. So 8,000, 12,000. The bottom line is you add it all up, you get to 40,000 again. So you see you're down to $1,000 again, just like in the straight line method. So let me ask you this, which one's easier? Straight line method where you just calculate at the beginning and then you're done and you just do a journal entry every year? Or doing it this way where you have to track your miles and then do the calculation and then each year have a different amount of expense. I like straight line. All right. Well, if you thought this one was bad, now wait till you learn about the double declining balance method. I don't like this method. I never have liked this method. Why anybody would want to do this is beyond me. Whatever. Okay. Some people are gluttons for punishment. So what we're doing is we're basically taking the straight line rate. So in this case of here, we had 5 years. Okay. The rate was 1 year in one in every 5 years, you're going to have that depreciation. So that's 20%. You're going to double it. 40% is what we're looking for. Right? That's what this is showing you. I don't like even the way this is being displayed. It's saying 1/5 years. That's 20%. Okay. 1 divided by 5 is 20%. 0.2. Multiply that by 2, that's 0.4. Well, in this method, we're not going to be focusing on the residual value. We're going to just subtract out the accumulated depreciation instead. This is going to calculate it for whatever year we're doing. So in the first year, right here, we have 21,000 or 41,000 minus 0 times the 2 times the 1/5, which is 40% if you combine those. So in year 1, you're depreciating $16,400. Year 2, now you're taking the 41,000, you're subtracting out 16,400. Doing the same math, you're coming up with 9,840. Here's the kicker. Here's the kicker. The last year depreciation is usually a plug figure, just like this thing says at the bottom. I mean, it's almost exactly how I said it. Reason for that is because this method makes it to where it doesn't always come out perfectly and neat like the other two methods. As a result, you got to watch it. You cannot depreciate it below its salvage value. Whoa, come on, Brian. Why did that do? All right. So you just do the same formula every year and you come up, look at that. You come up with another 1,000. So the bottom line is, let's look at these three methods. It's all the same. You get to the same amount. The accumulated depreciation in all three of these ways are $40,000. Which one's easier? Which one's easier? Straight line method is. So why are you going to do anything other than straight line method? All right, you may have your reasons. You may have your reasons. But I want to work for a company that's straight line. Most of the companies, I would be shocked. In fact, I would love it if when you do your research project in this course, that when you look for the depreciation method, I would love to know. Sorry, that young. I would love to know if you have anything other than the straight line method. Again, pairing it here. The book talks about makers. I'm not talking about you can do makers for tax purposes, but I'm not doing that. Partial year depreciation, bottom line is if you calculate your regular depreciation, all you got to do is multiply it by the attending months. If you bought it in July 1st, you're only depreciating it for 6 months. You can even do this is called the half year convention. Sometimes you just have a convention, right? It doesn't matter when you bought the asset, because if you think about a big company, we don't track each individual asset. We just lump it together and we just do our best, right? So half year convention is if an asset was brought online in sometime during the year, we're just taking 6 months of depreciation on it that year. We don't know. It could have been bought on February, it could have been bought in November. It doesn't matter. We're still taking 6 months on it. And then at the end of its useful life, we're still taking 6 months. So if the useful life is done in February or November, doesn't matter, just still taking 6 months. That's the half year convention. Then there's the half quarter convention, there's the half month convention. I mean, you can get really into the nitty gritty. And I think what it is it's just accountants and companies trying to find a way that they can squeeze out another expense, but not really have to do a lot of work for it, because doing these calculations constantly and tracking these assets can be very expensive, which is why it's not it's cost prohibitive. It's not cost effective. And that violates our cost benefit assumption, right? We're not going to do anything that's going to be high in cost, but it's not going to bring at least equal value to the company. All right, changing estimates of a depreciable asset. This is something that I need you to hear because your memo is going to be doing this. You're going to be doing a memo where you're going to be talking about a change in an accounting estimate. You're going to have an asset that you bought, and 3 years or some amount of time later, you realize that some parameters have changed. The emphasis is here is that it is not an error. An error, if you've made an error on your financial statements or something that you presented, you have to go back into those financial statements and fix it. Even if they were 2 or 3 years ago, you got to go back in time and fix it. not really in time, but you know what I mean, you go to those financial statements, fix them. If it's a change in accounting estimate, you don't do that. All you do is just change it for this current period and everything going forward. That's important. So please keep that in mind. So let's say we have this situation. We calculated that, 2 full years, here's the situation, whatever. But then, what's the change in this? Purchase on January for 2 years, truck costs $41 a 5-year life. Boom. Okay, so we're at $16,000 there. Remaining feasibility is 25,000. Okay, I guess it's right here. But now we believe that the useful life is for 6 more years, for a total of 8 years. And initially we said 5 years. So what we have to do is we have to take whatever the book value was, subtract out. Okay, it's not really showing you, but it's calling it book value. That's fine because that's true. Sorry, I wanted to make sure it was doing it right. The book value is your original cost minus your accumulated depreciation. Okay, so you got to make sure you do that. And then you subtract out the revised residual value. If it's revised, I think it was the same as before. What was it before? Yeah, it was last time it was about, but it could have changed. And if it did change, but regardless, you still subtract it out. And then you divide it by whatever remaining useful life is, 6 years in this case, not the 8 years that it's told, because we've already depreciated it too. So we're only depreciating it over another 6 years. That's going to give us our new amount. You're going to do this exact same thing on the plan asset memo. So please make sure you understand these last slides. And here's your journal entry to record the depreciation expense of the truck and the accumulated depreciation. All right. When we report it, we're putting it on the balance sheet. We put it as the building minus its depreciation and shows the amount. Disposal of plant assets. So what we're gonna do, if we're just disposing of it, we're just throwing it in the trash, we're gonna debit the accumulated depreciation and credit the equipment. It's gone. Okay. That's assuming we depreciated it fully and it's just gone. So thank you very much. Goodbye. Doing that will give us zero balances in their ledger accounts. But what happens if it's not the same amount? What happens if we actually sell it? Before we discard it, we bring it up to date on the depreciation. Okay, that's what this is. Suppose we set it on January 1st, July 1st, for our touch learning discard the equipment. China costs 10,000, but not fully depreciated. Accumulated depreciation 8,000, and annual depreciation is 1,000. First step, update the depreciation. This situation, I don't know why they combined. I'm sorry, I was going back in time on the slides because I don't know why they continued 3 of 5 with this situation, because they've changed the situation. Fine. So instead, we got $500 now. So now we're up to 8,500 of accumulated depreciation. So our book value is 1,500. In this case, if we're disposing of it at this point, now we have what's called a loss. We didn't get to expense the full amount before we discarded it, and therefore we are going to debit a loss on disposal. Losses act similar to expenses, so their normal balance is a debit. Gains act like a revenue, so we're going to credit it. Not that they are expenses or revenues, just that they follow those conventions. So a loss we're going to debit, and then we're going to credit that equipment. You see, we still balance. Okay, we're going to just get rid of the equipment and the depreciation. There we go. So what happens if we sell it instead? Well, again, make sure we get all the depreciation up to date. And then when we sell it, it depends on what we get for it. If we get in this case, we have a $1,500 is what it's valued at, or on our books. Well, if we sell it for $1,500, it's a wash. We sell it for, well, and this is the example. We sell for 1,500 right here. It's just a wash. We don't have a gain or a loss. We just sold it for what it was worth. But what if we sold it for more? Well, in this case, if we got $4,000 cash for it, That's more than the 1,500 it was left to depreciate. So we have a gain of 2,500. Just credit the equipment, debit the accumulated depreciation, debit the cash. The difference is if you need a credit to balance the journal entry, it's a gain. If you need a debit, it's a loss. But all you have to do too is look at, hey, we only have this $1,500 left to expense or whatever. But so if you get more than that, it's a gain. You get less than that, it's a loss. Okay. So what happens if it's a loss? We only got 500 instead of $500, and the accumulated depreciation is 1,500. Well, we have a loss on the disposal. Here's your journal entry for the loss. Okay. You can pause this at any time to look at this, but this video is already getting pretty long in its time. Here's a summary of what we just went over. It's discarded if it's sold. Okay. All right. Natural resources. Let's get into this. Before we begin on that, let's go ahead and give you your word for this video. It is parkour. Parkour, parkour. Okay. Papa, Alpha, Romeo, Kilo, Oscar, Umbrella, Romeo. Parkour. All right. So natural resources. Natural resources operate a whole lot like the units of production method. I'm not going to go into this into great detail because it really is the same thing. It's just instead of depreciation, it's depletion. Instead of units of production, it's estimated total units we think we're going to pull out. So we come up with our per unit that that we expect to get out of the total amount of this natural resource, and then however many we pull out, we multiply it by that rate. Okay, and then we just do the same journal entry, except instead of depreciation expense, it's depletion expense, and instead of accumulated depreciation, it's accumulated depletion. Okay, so it really isn't all that big of a deal. And then there's intangible assets. What is an intangible asset? Is anything that is valuable, but it's not something that you can really see the value in. Like if I look at a building, I can see the value in it, right? Other people can go and look at it and say, all right, it's worth this. Well, you can't do that with patents, copyrights, trademarks. You can look at the Nike swoosh, and you can't see in the Nike swoosh the value that brings. It's an intangible asset. Okay. What we're going to do with most intangible assets is we're going to amortize them over their estimated useful life. Some of them are 5 years, 20 years. Patents are a long time. Logos, trademarks, things like that. But it's only the ones that have a definite useful life. There are things that don't have a useful life. One of them is called goodwill. And when we do that, we just test them for impairment. You just need to know that. Just know that it exists. I'm not going to be doing any of that in this video. And a patent is an intangible that has a 20-year life. And so you can, do whatever you got to do with that. Patent it, produce it, sell it, stuff like that. So if we have a patent here, we acquire the patent in $200,000. We can appreciate that over the life we have to use that patent, and we just divide that by the amount. There really is no residual value of a patent, so we're not going to be doing that. Anyway, here's your journal entry. I'm going to just kind of click. You can pause these at any point you want and look at this information if you want to. Here's goodwill. I don't want to get into goodwill. It's just understand we test for impairment. That's all I want you to really know. If you really want to pause it, you can pause it that fast. Here are the 3 things we talked about: plant assets, natural resources, and intangible assets: depreciation, depletion, and amortization. Okay. I love how they put this gas can on like half these slides. It's really odd. Asset turnover ratio. What we want to do is be able to determine the net sales generated for every time for all of the average dollars we have contributed to assets. So what we're going to do is we're going to take our net sales revenue and divide that by our average total assets. We calculate average total assets by taking the beginning year, adding it to the ending year, dividing by 2. Simple as that. And we're not going to go into exchanges. You'll probably cover that in an intermediate one. So if you have any questions, guys, let me know. Good luck. We'll see you guys in the next chapter.